Dear learners, welcome back to the fourth module of financial management. In that we were discussing about leverages. So, some illustrative problems we did on operating leverage, financial leverage and combined leverage. Now, in this session we will discuss further about the implications of leverages. Let us discuss about the impact of leverages. Positive impact of leverage: when returns exceeds the cost of debt, leverage increases return on equity. This is all we have discussed in the beginning. Just for more clarity, if leverage increases return on equity as debt is used to fund investment that generates returns greater than the cost of debt. So, if the return is greater than the cost of debt, then it will have a positive impact. For example, if a company borrows at a 5% interest rate and earns 10% return on assets, then the difference 5% boosts the equity returns. So, that the difference amount of return will go to the equity shareholders. Negative impact: when returns are less than the cost of debt, of course, then loss will be the result, or in the income decreases. Leverage can magnify losses. If a company earns less than the interest rate, the earnings of the company is less than the cost of debt, then the income will decrease. And that is with respect to the impact, positive impact. Then risk considerations, see, we already discussed that when leverage is high, risk also will be high. So, financial risk, the risk associated with the use of debt, if that means if a company uses high financial leverage, then if a company cannot meet its debt obligations, it may face financial distress or bankruptcy. So, the higher the debt level, the higher the financial risk, especially if the company's revenue is volatile. So, debt sources of funds, as I mentioned in one of the sessions, the previous sessions, if the investment is for a longer period and return from the investment expected after a period of time, in such cases firms prefer to go for equity source of funds than debt source of funds. Why? Because if debt source of fund is used, then interest payment is mandatory. So, that all we discussed, I hope it is clear to you. That is with respect to financial risk. With respect to business risk is concerned, risk with respect to the operations, that is operating leverage is concerned, the inherent risk in the company's operations which is unaffected by its capital structure. That means a company with the stable revenues and profits can afford more financial leverage compared to a companies with volatile cash inflows. So, then practical application of leverages, leverage in practice. High leverage common in capital intensive industries, which are capital intensive. Examples: utilities, companies involved in selling of utilities, real estate companies where high fixed costs are associated with assets. So, these companies often use debt to finance the acquisition of tangible assets like property, equipment, etc. So, real estate companies, utility companies dealing with utilities, they use high financial leverage, high leverage they use, usually they use. Whereas technology based companies, because technology is volatile, technology changes, and unless otherwise the company is agile, they will not be able to make profit. So, since technology is changing, so industries with which uses technology, they prefer to go for less low level of leverages as the risk is high. So, if the risk is high, if the return is volatile, there is no certainty that they will be able to make positive returns. In such cases, going for high leverage is risky for companies. So, with this we will now end up the portion on leverages. So, in length and width we discussed about leverages. I hope it is clear to you, both theory as well as the practical problems are clear to you. So, now in the next session of the syllabus, that is dividend decisions and policies. Actually, dividend decisions and policies is very easy to understand, very simple. There is no complexity. Even in leverages also there is no complexity if you understood the concept. So, dividend decisions, as you know, it is dividend is the return given to the equity shareholders for their investment, and some basic aspects we have already discussed. Payment of dividend, even if there is profit also, it is not mandatory, but companies usually pay dividend. If there is profit, companies usually pay dividend. Even if the dividends are paid also, the amount of disbursement in the form of dividend will be a small portion of the profit only will be distributed. Major chunk of the profit will be retained in the business as retained earnings. It will be used for reinvestment. It will be used for the investment in business. So, these are the fundamental things about dividend. Now, we will go further about it, and we'll study what is all about dividend decisions. These decisions involve determining the amount of earnings to be distributed to shareholders in the form of dividends versus the amount to be retained for reinvestment in the business. So, that is what I mentioned. So, dividend decisions means decision with respect to how much money should be retained. So, dividend, how much amount has to be paid as dividend is dependent on how much profit is available and how much money should be retained in the business, how much profit should be retained in the business. Based on that, decision will be taken about how much dividend has to be disbursed. Okay. And again, as I mentioned earlier, how much money should be retained in the business is dependent on the investment opportunity available for the company, because if the money is not useful, if there is no opportunity for investment, then simply keeping the money with the company, again it's of no use and it won't give any return or any benefit to the shareholders. So, if there is an opportunity for reinvestment, then the money will be retained on the basis of investment opportunity, and accordingly the dividend amount will vary. So, the dividend policy a company adopts can have significant implications for its financial health, investor perception and stock price. So, dividend policy of a company determines, or it has its own implications on its financial health. That means, if a company in any year, if they fail to pay dividend, then the reason may be reinvestment, amount will be retained, and will be, the purpose will be for reinvestment, but there is a chance that it may send a message, wrong message to the public, that the company has not made profit, the company is not healthy. That is the reason why the dividend is not paid. Suppose, for example, in the previous year, if 10 rupees dividend is paid, for example, 10 rupees dividend is paid, in the current year also, minimum the shareholders will expect a dividend of 10 rupees. And if the company fails to pay that at least the same amount of dividend, again if the company is able to inform the public that the reason why the dividend is paid is lesser than the previous year, if justification can be given, that means that amount is retained and it is for reinvestment, and from that investment it generates more profit in the future. If that justification can be given, it is okay. Otherwise, it send a message to the public that the company is not performing well, the company has not made profit. So that is that implication is there. So, dividend policy has implications on financial health of the company, investor perception. If in this example, if the dividend paid is less than the previous year, or dividend is not paid at all, so what the investors will perceive, what they will think, the company is not performing well. So, that is implication, and it will have an implication on stock price also. If the public feels that, if the investors feels that the company is not healthy, that is the reason why dividend is not paid, or that is the reason why dividend is less when compared to previous year. So that will have an implication in the stock market, then you know that in the stock market the share value of a company, once it is issued, the public in the secondary market, share value of a company is fluctuates based on demand and supply. If demand is more, then price will go up. Demand for the shares of a company is high, price will go up because there is more demand, so the sellers will ask more price, and vice versa. So if there is no, so if the dividend payment is less when compared to previous year, or dividend is not paid, and if they feel that, investors feels that the company is not performing well, in such cases what will happen, the demand for the shares of such kind of companies will decline, and thereby the market value, market price of shares of the company also will decline. So all these are the implications of dividend policy. So dividend policy has implications. Dividend policy of a company have implications on financial health of the company, investor perception, as well as stock price. Let us have an overview of dividend policy. Dividend policy refers to the guidelines or principles a company follows in deciding how much of its earnings should be paid out as dividends to shareholders versus retained in the business for reinvestment. So dividend policy as such refers to how much of profit has to be retained in the business and how much dividend has to be paid. So the policy depends on several factors, including profitability, because how much dividend can be paid is based on not purely but mainly based on profitability. If profit is not there, dividend cannot be paid. So when compared to other factors, first thing is, the foremost thing is the profitability of the company, how much profit is made by the company. Profitability, the investment opportunities available to the company. As I mentioned earlier, if investment opportunities are available, money will be invested in that opportunity, and so that more money will be retained and less dividend will be paid. Then legal restrictions, if any, say no dividend has to be paid or minimum dividend has to be paid. If any legal restrictions are there, that needs to be considered. Then, and the company's financial structure, the financial structure of the company also needs to be considered in devising the dividend policy of a company. Having understood the fundamentals of dividend and dividend policy, now let us discuss about what are the different types of dividend policies. Types of dividend policies means policy of the company with respect to payment of dividend. First of all, some companies follow stable dividend policy. What is stable dividend policy? The company aims to pay a stable and predictable dividend, often increasing it gradually over time. So every year a predictable or a stable dividend, stability in payment of dividend. So stability in payment of dividend means shareholders can expect minimum the company will, a company following stable dividend policy, in such cases shareholders can expect that minimum this percentage of or this much dividend I will get in the next year also, like that. So company follows stable dividend policy. So this policy is ideal for mature companies with the steady cash flows and minimal investment opportunities. So if a company has investment opportunity, then in such cases the same dividend what is paid in the previous year, the company may not be in a position to pay, because more amount needs to be retained for reinvestment. So in such cases, then such kind of companies cannot follow stable dividend policy. Then for example, a company pays a fixed dividend per share every quarter or year regardless of fluctuations in earnings, then it is an example of the company is following stable dividend policy. Other type of dividend policy is constant dividend payout ratio. Constant dividend payout ratio, that the ratio, that means a fixed percentage of earnings is paid out as dividend each year or each period. The payment of dividend, a company fixes whatever be the earnings, whatever be the situation, say a fixed percentage, 10% of the earnings will be paid as dividend. So, if that is a policy, means that is a case of constant dividend payout ratio. So, the difference between stable dividend policy and constant dividend payout ratio, in constant dividend payout ratio, a fixed percentage will be paid to the shareholders every year. So, as earnings increases, the dividend paid to shareholders increases proportionally and vice versa. So, if there is increase in under constant dividend policy, though a percentage is fixed, if the earnings increases, dividend paid to shareholders increases. Of course, the percentage is same also, fixed also, 10% means if the earnings increases, profit increases, then shareholders will get more amount of dividend. Okay. This policy is more volatile since dividend payments directly follow earnings fluctuations. The volatility in constant dividend policy is because of the changes in earnings. If earnings increases, shareholders will get more dividend. If earning decreases, shareholders will get less dividend. So, in constant dividend policy, fixed percentages will be fixed for payment of dividend. Then we have residual dividend policy. Under residual dividend policy, dividends are paid from the earnings remaining after all profitable investment opportunities have been funded. After paying off to all the, or after making all profitable investment opportunities, whatever remained, that means investment outside the business will be done. Some amount will be put in maybe fixed deposit for using it for emergencies. Then for working capital, for financing working capital, some amount will be kept. After doing all these, whatever is left will be paid as dividend. That is what is called residual remaining balance amount after making all profitable investments. Whatever balance amount is available, that will be paid as dividend. The company first uses its earnings to finance investment, and any remaining earnings are there that will be distributed in the form of dividend. And certainly this kind of dividend policy leads to fluctuations in dividend payments based on the company's capital expenditure needs, based on the investment requirement. The dividend amount, payment of dividend, amount of dividend paid will vary from year to year. If much requirement are not there for investment, then more amount will be paid as dividend and vice versa. Then we have hybrid or progressive dividend policy. It is a blend of stable and payout ratio, stable dividend policy and dividend fixed dividend payout ratio, where the company pays a regular dividend and supplements it with additional dividends when earnings are high. So, stable dividend policy wherein fixed amount, stable about regular amount of dividend will be, that means a minimum amount of dividend will be fixed, that will be paid, and increase or decrease based on the profit. If there is profit and if much investment opportunities are not there, along with that stable regular minimum dividend, an additional amount will be paid as dividend. So, that is what hybrid dividend policy. So, companies with this policy increase dividends over time, but may adjust based on long term profitability. So, with respect to dividend policy are concerned, we have discussed stable dividend policy, constant dividend payout ratio, then residual dividend policy, then hybrid or progressive dividend policy. These are the different types of dividend policies. With this we will wind up this session, and in the next session we will discuss about the factors influencing dividend decisions. Thank you.